This is the fourth quarter update for the Amplify Seymour Cannabis ETF, symbol CNBS. Joining me for this update is Tim Seymour. Tim, why should investors invest in cannabis-related companies?
Hey, Jay, great to be here. Cannabis as an industry has caught investors' attention for the last 5 or 6 years, but certainly in the last few, based upon just the sheer size and the growth of the sector. If you look at the addressable market in cannabis that exists today, not where we want to be, not where we think it's going to go, but right now when you consider the adult markets or the recreational market, the medical market, and then even the illicit market, which exists and is part of that transformation of the sector, it's a $100 billion sector now, which makes it bigger than beer, wine, and spirits, which means as you evaluate both investments in both high growth consumer sectors that could either be seen as staples or discretionary items, cannabis fits the bill. I think the reason for investing tactically here is that most investors are not and cannot be exposed to cannabis investing on some level. There's a big wall of institutional capital that's still unable to invest in the sector. And I think that's not necessarily because of federal fear. Some of it is just related to the dynamics around the custody banks and the prime brokerage. And I think that's also something that's going to change. We're not here to give a forecast on the timing of when some of these federal legislative changes take place. In fact, we're here to invest right here and now, almost bottom up, also on a sector, though, that has tremendous macro.
Tim, when you look back on the fourth quarter, let's talk about some of the changes in the portfolio, and let's start at the subsector level. What changes did you make?
One of the things we did do in the fourth quarter was actually increase some cash in the portfolio. I think the environment, both global markets, and I'll always say this about any new asset class, and as a guy who has a background in emerging markets, when you have higher volatility and you have I'd say a risk-off environment globally for stocks, it's not great for cannabis. We actually increased some cash in the portfolio in the fourth quarter with a view that we're going to have an opportunity to invest a little more aggressively sometime in the first part of the year. To be clear, our mandate is to be invested in the space. So when I talk about a cash position a little bit north of 10%, that's, I think, significantly high for a cannabis dedicated fund. And again, reminding investors that 80% of our portfolio has to be invested in companies that have 50% more of their revenue stream in cannabis. I would say we probably, if anything, increase some weightings to some of the ancillary players in the space. So whether they be retailers in terms of online tech companies and e-commerce companies, some of the debt providers and the real estates and the REITs that have been such an important part of the sector, both in terms of those companies that actually can lend into the sector, but also in terms of those companies that really do exist on the New York Stock Exchange or on the NASDAQ. So places where we can invest in a SEC 40 Act ETF product where, as you might imagine, there's some limitations to what we can do. So if anything, we added to some REITs. We added a little bit to some of the debt providers. We added to an e-commerce player called Weedmaps, who had a very difficult fourth quarter. But our view is still they are the market leader in the e-commerce space. And I think, if anything, their business is going to continue to grow. We probably held serve, if I may, in terms of our exposure, which really is the top of the balance sheet, to the multi-state operators in the U.S. Those are the companies that are in anywhere from 3 to 21 states in the case of Curaleaf, companies that we think have the best balance sheets, that are the best positioned and vertically integrated. And we probably added a little bit more to Tilray, which is, we think, the most attractive LP or Canadian company that operates in the space today.
So let's go a little deeper on Tilray. What is the investment thesis behind that company for you?
Tilray is a company that, to be clear, until they merged with Aphria, which was one of the other kind of big three, big four in Canada, the company was not that interesting to me because they burned cash. They spent a lot of time focusing on parts of the world they might get into at some point, still at very low market share in Canada. When they merged with Aphria, which was the most profitable free cash flow generative operator in Canada, that immediately changed their business. Irwin Simon, who's the CEO of this company, is someone that knows CPG, knows the consumer staples and the consumer discretionary world. And I think if I look at the business that Tilray has expanded in the last 2 years, much to the criticism of some people inside the cannabis space, they've actually been diversifying their business into wine and spirits segments, and have bolted on companies that are actually free cash flow generative and have been, I think, complementary to the overall distribution footprint of the company. And look, as cannabis continues to grow and some of those beverage segments opening up, I think they're obviously going to be very complementary to Tilray. But at a time when cannabis companies are struggling with free cash flow, this is one of the few companies that's actually generating free cash flow, and a company that I have a lot of confidence in their ability to navigate a difficult environment today.
So we produce these quarterly video updates, but I want to make sure that viewers know that Tim and Amplify produce a regular broadcast called the Cannabis Recap, and you can catch that at cnbsetf.com. That's cnbsetf.com. Tim, let's wrap up with your outlook. So we're recording this in January of 2023. What are your thoughts on this sector for the rest of the year?
Well, my thoughts are that 23 is going to have trouble, I think, reaching the disappointments of 22. And 22 came after a disappointing 21. And I say disappointing because it's not just about the return profile. Cannabis had a difficult year in terms of returns. But I think it was the disappointment on the legislative front. And so there were high expectations both in 21 and even at the end of 22. I would make an argument that there was a disproportionate reaction in the market to the failure of Washington to get anything done in the last congressional session, when Democrats had control of the House of Representatives, and it was expected that they could then push something through the Senate. So none of this happened. And you can make an argument that the 30% fall in the entire sector that took place from December 5th through the end of the year was an overreaction. Again, we're investing in the sector based upon not our hope to see a federal headline tomorrow. It's finding companies in a sector that continues to grow with this massive top line and addressable market. And that's really the story in 23. The story in 23 is the operators that are the most efficient operators, I think, get a little bit more efficient. There's no question that a difficult capital environment means that companies are being more respectful of free cash flow and therefore maybe cutting back on CapEx, maybe being more efficient in terms of new projects, maybe mothballing new projects. But it's about finding companies that I think are, again, executing in a difficult environment. And maybe actually, you're starting to see some bottoming process in pricing across a number of the different states that have seen major headwinds in price compression. So at some point as an investor, and I've seen this in emerging markets and I see this in almost any market, it really does come down to valuation. Valuation does matter. At some point, companies get so cheap that you say, oh, wow, I never thought I'd see that here. I'm not going to tell you that that's where we are in cannabis, because I'm not even sure we know what that number is in cannabis because it's such a nascent industry. I'll tell you that between 4 and 8 times EV/EBITDA in 23 is as cheap as this sector's ever traded for the biggest and most established players that will be in business tomorrow and next year and beyond. So I think the valuations are compelling. I think the sentiment coming out of 22 was so poor. And arguably you had a disproportionate sell-off in the markets on the failure of DC to get their act together. So that's really the outlook for 23. Nothing changes in terms of the operating environment on the here and the now. And I would make an argument that the legislation a lot of people were really hoping for didn't change the scope of the businesses of these companies as it was. It was really about safe banking and having the industry that's a heavy cash industry be able to use more banking. It doesn't necessarily change how these companies were going to run. So we're excited by 23. We continue to think that this is one of the big growth consumer sectors that soon will be as sophisticated as other CPG that we know, consumer staples or even discretionary, are places investors want to have exposure to.
Tim, thank you so much for your time. Financial advisors, investors, learn more by visiting cnbsetf.com. That's cnbsetf.com.